Hello everyone, welcome to Atomic ACCA's Pre Mock Exam Solving Series. In this particular video, we're going to look at question number 1 of the SBR March 2025 exam. Now, we know generally this question is put around the consolidation area and it might test you around some other accounting standards as well as part of the sub requirements in the question. But the main topic will still be around the group accounts topic. So, first off, let's look at how the requirements are given to us before even going ahead with the case study. Number one, using Exhibit 1 and in accordance with IFRS accounting standards, explain with calculation how to correct the treatment of Gamba Company in consolidated financial statement for the year ended 31st December X7. Now, we have to use only Exhibit 1 over here, so that is one indicator. Once you're done with Exhibit 1 itself, you're good to go answer these questions. Second thing, you have to explain with calculation, which means you have to talk about this and as well do the numericals as well. Both will have marks, so don't stick around doing only the number work and leave it off over there. Use your Excel sheet to do the numbers, and you can just put up the wordings within your word processor, and that is for 11 marks. B, using Exhibit 2 and in accordance with IFRS standard, explain with calculation, again both part is there, how to correct the treatment of sales company. So first one was Gamba company, next one is sales company, and it is in the consolidated financial statement for 31st December X7. Okay, that is for 5 marks, so relatively a smaller question. Using exhibits 1 and 2, so whatever you did previously and your previous answers, adjust the pre-populated spreadsheet response to correct the draft consolidated SOFP. Because it's an SOFP question, it's a little more simpler to do this because you can always see whether your answer is going right or wrong based on whether your balance sheet is matching. So your total assets is supposed to balance out your total equity plus liability, and if everything is balancing, your answers would be correct. And if everything has to balance, you need to make a debit and a credit entry for each of the adjustments that you're making, and you're good to go with that topic. So this is how our whole question paper is set for your question number 1. Let's copy this entire thing into our word processor so that we know what all questions we have to do along with the marks. We have question number A, we have question number B, and we have question number C. So this is question number A, this is question number B, and that's question number C. So why we do this is so that we don't have to open that requirements page anymore. We can just put up our answers over here, and we have our marking scheme as well. So we know how much to write for each topic. Now definitely the last one is related to pre-populated sheet. So right now itself you can write and keep over here. Refer to spreadsheet for solution. So this answer we're going to do it on the Excel sheet. So that is done. Now we have to solve out these two parts. Let's start reading the exhibits one by one. Going to exhibit 1 over here, we have the acquisition. Now it looks too small, so we can just make it into little more size. Okay. All right. So on 1st Jan X7, our year ending is 31st December X7. Enrix company acquired 60% of the equity share capital of Gamba company. So parent is Enric company. Subsidiary. First question was about Gamba company, and they acquired 60%. Consideration transferred by Enric company, that is parent, was 50 million cash. Enric's company must also make a further payment of 35 million on 31st December X8. So you're on 1st Jan X7 date of acquisition, 31st December X7, 31st December X8. So there's 2-year timeline. So after 2 years, you're supposed to pay 35 million. Today you're paying 50 million. So there's a cash consideration and a deferred cash consideration within your payment plan, but no accounting entries have been recognized in relation to this. You can see that there's a full stop over here, which means they're talking about no accounting entries being made is related to the deferred payment, and the original cash payment they have accounted for it. So something about deferred consideration, we have to deal it in the first paragraph. Now, before forgetting this, what we can do is we can open up our Excel sheet, because from the requirement we already understood from exhibit 1, we have to explain with numbers what all are the adjustments to do. So in order to do the calculations a little faster, we can make use of our Excel sheet in order to support our numbers. What we can do is take up the spreadsheet, and we know that already the pre-populated sheet will be available over here. Let's not touch any of that. Just go down and write requirement 1, or you can just write question number 1. Question 1 related to Gamba company. So what are we going to do over here? We're going to write the working notes. So working notes of question number 1 basically will be writing up all the control U, control B for underline bold functions will work in your exam as well. Make use of that. You don't have to keep on clicking and typing this underline button in order to do that. So hope that part is okay. Now the paragraph we read is about working note 1, and that is about deferred consideration. So we'll just write over here working note 1 about deferred consideration. Now we don't know what are the numbers and all completely. We just know that some 35 million is to be paid 2 years later. But we know the accounting part. We have to take the present value, then we have to compound it, find the finance cost and all. But we don't know what is the finance cost percentage to take over here. So before entering into the calculation, just so that we don't forget what to do, just write the steps over there and keep payment of 35 million 2 years later. So find present value. Later compound it and find the finance cost. So we just wrote what adjustment is to be done. We'll do the adjustments later on once we find the figures. So let's go back to the case study. This is one adjustment to do. Now, the carrying amount of Gamba company's net asset in its individual financial statement, so subsidiaries net asset in the individual FS at the acquisition date was 80 million. So net assets of subsidiary 80 million, but it's not the fair value. Keep in mind they have given carrying amount. Now, included in this net asset at acquisition was a factory building with a carrying amount of 10 million and a fair value of 40 million. That means on the date of acquisition, from 10 million, a shift to 40 million is to be done, a 30 million hike. So fair value gain of 30 million will happen. Now, and a remaining life of 15 years is there, which means by the date of reporting, there will be some additional depreciation to be done on that. 30 million divided by 15 years, we will get the additional depreciation figure. Now, the tax base of the building is its carrying amount in the individual financial statement. That means fair value of the asset is consolidated books, carrying value is individual books. So you're going to compare the consolidated book and individual book. What is this going to lead to? Generally a deferred tax problem. The tax rate in the jurisdiction is 20%. Net assets of Gamba company have been included in the draft consolidated statement of financial position at their carrying amounts, which means fair value adjustment is not done. We will have to do it. From second paragraph, what are the inputs we got? We'll just write it in our Excel sheet. Where is it? Working note 2 is about net assets adjustment. What is given over there? Fair value of factory to increase from 10 million to 40 million on date of acquisition. 15 years life is remaining, so additional depreciation to calculate. Then one more thing was there about tax rate. Tax rate is 20% used for deferred tax calculation. So we know what to do from second paragraph as well. Let's go read the third paragraph. What is given? It is group policy to measure the non-controlling interest at acquisition at its proportionate share of fair value of the subsidiary's identifiable net asset. Subsidiary's net asset at fair value multiplied by the NCI percentage. This is going to give you the NCI value. Now how much percentage is NCI? 60% is parent, so 40% is NCI. Now, goodwill arising on the acquisition of Gamba company has been measured and recognized at 32 million in the draft consolidated statement of financial position. So goodwill arising on acquisition, this was calculated as follows. Okay, numbers are given here. Cash consideration 50 million paid. So deferred consideration not considered. Non-controlling interest at acquisition is 40% NCI value multiplied by 80 million. What is 80 million? It is the carrying value. So they've told over here net assets of Gamba companies included in SOFP at carrying amount. So they took the net asset at the carrying amount. There is adjustments to be made on that. NCI is calculated on that carrying amount, which means NCI value will also be adjusted now. Based on net asset movement being going up and down, NCI value will also go up and down proportionately. Finally, they are telling goodwill at acquisition is 2 million. What is given here? 32 million. 50 plus 32 is 82. 82 minus 80 is 2 million. So this is probably a typo error. Just ignore that 32 million. It's only 2 million. And finally, it's given that a discount rate of 5% should be used when required. Now, why do we need that 5% thing? In order to find the present value. So that also we can write over here. We'll take later compound and finance cost based on 5% interest. So now we got that information. From third paragraph, we got the idea about how to find the fair value of NCI. So you can just write over here. NCI value is based on proportionate method. So now we got the idea about what all is to be found over here. The current calculation they have done for the goodwill amount is, we can just write over here, cash consideration 50 million they've considered. We need to find the deferred consideration as well, so we'll just leave a line for that. Then NCI value is based on proportionate method. It's taken over here as 40% of 80 million. So that is based on net assets of subsidiary on date of acquisition, that is 80 million, and we can write NCI value is equal to 40 percentage of 80 million. So that's 32 million. 50 million is considered over here, and finally the goodwill amount is there. Goodwill amount is equal to cash consideration plus whatever deferred consideration is supposed to come, that should be added, NCI value, and minus net asset of subsidiary on date of acquisition. So that's how that 2 million came up. Why did we represent over here? Because whenever some changes are made into the numbers, we have to show it on the goodwill calculation, so that it will help us identify what entries are to be made on the consolidated SOFP as well. Because third requirement was using exhibit 1 and the answers from your previous discussion, make the adjustment on the consolidated SOFP. So whenever we're making some adjustment over here, we're supposed to make it on the SOFP as well. So let's do this one by one. First is about the deferred consideration. How should we calculate that? Now you're not supposed to erase this and all, you can just keep as it is, no problem. So the examiner also knows what step you have done if in case any number you missed out. So this gives a structure in your answer. First thing, you're going to find the present value. So present value of 35 million discounted at 2 years, or discounted for 2 years. So that will be equal to 35 million divided by 1.05 raised to 2. Now raised to 2 is only for the time period, the denominator part, so I'll just put that inside a bracket. So we get the answer 31.74 million. This is the present value. What am I supposed to do this? I'm supposed to add it over here. So I'll just connect it over here. If I connect it, what has happened? My deferred consideration figure went up over there. Goodwill figure also went up. Now keep in mind, where does goodwill go to after this? It will go to my non-current asset. That means my asset value is going up. So I can write over here, this is passed as the entry debit goodwill, because non-current asset is increasing by how much amount? 31.74 million. And on the other hand, what is happening? The credit part, what is increasing? This deferred consideration is a payment that I have to make 2 years later. That means my liability figure today is increasing. So credit liability, that is deferred consideration, 31.74 million. So I'll just mark this in red color because I know that these are the entries I have to show it in my consolidated SOFP. So that is one part of the entry that I have to do. Now, if you have a question whether something is going to hit on NCI over here, no. You can look at the numbers as well. NCI value is based on net asset proportion. So nothing came up over here. Secondly, this payment is paid by parent. So this is solely the responsibility of parent and not about the NCI. So no values over here will go to NCI. It's all about goodwill. So hope that first entry is okay. Second, after this, what would happen? Finance cost is to be increased. So I'll just leave some line over here. Add finance cost for 1 year based on 5%. So that will be equal to 31 million into 5%. So 1.58 million increases. Now, when that 1.58 million increases, what will happen? If today I am supposed to settle the liability, I have to pay only 31.74 million. But I am settling this 2 years later. So after 1 year, time value of money will increase, which means I'll have to stack up more cash. That means my liability will increase. I'll pass the entry. Credit liability equals to this much. And what about the debit part? As said in the heading, this is a finance cost for the parent. That means this will be an amount that will come to group retained earnings for the parent and nothing for the NCI. So we'll just write over here debit finance cost, which basically will go to group retained earnings when it comes to the equity part. And that will be equal to this much. And that is also something I'll put in red color for reference. Okay, whatever. All right. So we got the numbers for second entry as well. So that is also sorted. Now we see that it's debit finance cost and credit liability. So nothing about the goodwill will change. And keep in mind, we're calculating goodwill on date of acquisition. So whatever happens post acquisition is not going to affect the initial goodwill figure. Keep that in mind. The only thing that will affect the goodwill is the impairment figure. But that is not something part of the discussion we had. So we don't have to bother about that. So these are the numbers we have from the first entry. We did the calculation bit. Now what we can do, we can go to our word processor and do the explanation part as well simultaneously. So I'll just move away this topic because we don't need this anymore. We'll just go to word processor. We have our first thing. So we'll write over here the first section on what we have to write, the calculation regarding the deferred consideration. So we can write first the deferred consideration or the acquisition made involves two payment plan, cash and deferred cash payment. The deferred cash consideration has not been accounted for in the goodwill calculation. As per consolidation rules, on date of acquisition, the present value of future payment is to be recorded and considered for the goodwill calculation. This discounted figure will hence be how much? 31.74 million. Be 31.74 million. That is 35 million or you can just write 35 million divided by 1.05 raised to 2. Next, the entry we pass will be debit goodwill, credit non-current liability. Next thing, what happens after this? This liability by the date of reporting shall be compounded. Hence, the finance cost is to be added on the figure, which is how much was it? 1.59 million, which is 1.59 million. How did we calculate this? Present value, that amount was 31.74 million multiplied by 5%. So we got that number. The entry we made was debit finance cost, which goes to GRE, credit goodwill amount. No, credit liability, the non-current liability part. So that entry is also done. So this was the adjustment we made. We explained it in numbers as well. So here we explain these things for our own reference. Here, this is part of the answer. So in the Excel sheet, it's not mandatory that you have to make it this explained. You can just put out hints, because as said, this is only for your reference. So you don't make a mistake later on. The main part is writing in the word processor, meaning the explanation part should be there. So this is the key idea, keep in mind. So we're done with the calculation bit, we're done with the explanation bit. Now get on to the net assets adjustment. What is to be done over here? Fair value of the factory is to be increased from 10 million to 40 million. So what adjustment will happen? Asset value will increase by 30 million. When asset value increases by 30 million, what will happen? Two things will happen. Number one, debit non-current asset increase by 30 million. Secondly, when this non-current asset value increases on date of acquisition, it's a fair value adjustment. That means your net asset value on that day will also increase. So now you have to be a little careful. Net asset value is 80 million currently. So on date of acquisition, it will increase by further 30 million. See what all changes are happening. Equals to 80 million plus 30 million. So now keep an eye on all the numbers over there and see what all changes. What all changed right now? Net asset figure changed. NCI value changed. Because of that, goodwill also changed. Now, previously, what was the goodwill figure? It was 33. Now, what is the goodwill figure? 15. So, keep in mind, goodwill figure went down. What else happened? Previously, NCI value was only 32. Now, what happened? NCI became 44. So, NCI value increased. So, what all changes are happening? First thing, definite, non-current asset value is increasing. Second, what is happening? Debit goodwill amount. Sorry, debit. No, goodwill is part of non-current asset. Goodwill amount was decreasing. So credit goodwill amount, non-current asset. And what else is decreasing over here? Over here, we saw that the NCI value was increasing. NCI is part of equity. So equity increasing is a credit entry. So credit NCI over here. So these are the changes happening. Now, how much amount of changes are going into each of this? Because one debit is there and two credits are there. So we have to proportionately allocate this. How much will be the allocation? NCI will get a share of that net assets proportionate growth. NCI grew, I mean, net asset grew by 30 million. So 40% of 30 million will go to NCI. So 40% of 30 million will go to NCI, and the remaining part will go to goodwill. So how much will be remaining? From 30 million, if I minus out 12 million, it will be 2018. So 18 million will credit to goodwill figure. These are the entries we have to pass with regards to that fair value adjustment. So this part is also ready. Next thing, once that asset value increases on date of acquisition, later what will happen? This will get depreciated. So the depreciation is happening for 15 years. So NCI value now we already understood, so let's forget this. Next thing, additional depreciation calculation, that will be equal to the extra value 30 million divided by the remaining life of 15 years, and this is a 1 year calculation, so that will be 2 million depreciation. When a depreciation is happening, what would happen? We know that, just connect back to our FR knowledge for net asset calculation. When fair value adjustments are there, what happens with the excess depreciation? It will be there in the post acquisition column. From the post acquisition column, what happens? This will go to parent split and this will go to NCI split. That means this 2 million will be split to debit group retained earnings by the parent percentage, and it will go to debit NCI by the NCI percentage. Why debit? Because this is an expense figure, additional expense it is. So when it goes to the equity column, it's going to bring down these equity figure because of additional expense. How about the credit entry? 2 million excess depreciation is related to non-current asset, that factory. So what we have to do? Credit entry, we have to put it on the non-current asset by 2 million. So the numbers will be 2 million into 60% for parent, 2 million into 40 percentage for NCI. So these are the entries we have to make for additional depreciation, and that also will mark it in a red color because this is an adjustment to make. Now keep in mind, this adjustment is also post acquisition, which means our goodwill figure or no numbers over here is going to get adjusted because of that. This is a post acquisition figure or post acquisition adjustment that will happen in your SOFP or SOPL. So that is also sorted. We told one more point about this, that is the tax part. So we can just write over here deferred tax implication. What is the deferred tax implication? On date of acquisition, on date of acquisition, the fair value was in excess by 30 million, and over here in that is in the individual statement, that difference is there, that is fair value consolidated SOFPs additional by 30 million. So you can just write like this: carrying value is 30 million, or we'll just write over here carrying value is 30 million, tax base is 0. So this is the gap they have. So carrying value being greater than tax base will lead to a taxable temporary difference, and that difference multiplied by the tax rate will lead you to deferred tax liability. So we have a deferred tax liability on date of acquisition opening. So on date of acquisition, if a deferred tax liability is coming up due to fair value adjustment, this is supposed to go and hit on the non-current assets, net assets over here. So some adjustment will come up on the goodwill calculation. Let's find the numbers first. This will be equal to 30 million multiplied by 20 percentage tax rate. So that will be equal to 6 million. On date of acquisition, if liability is increasing, previously when asset increased, we saw that net asset figure went up. So what if liability will go up? Net asset figure will come down. So we have to make an adjustment over here. By how much? 6 million. Now keep in mind of the numbers over here. NCI value is based on the net asset. So NCI will change. When the net asset figure changes, goodwill will change. So keep in mind what all changes are going to come up right now. Net assets are going to go down by 6 million. So 6 million, if I reduce, NCI value went from 44 to 41. So NCI value came down. How about goodwill figure? Goodwill was 15 previously, now it increased. So we can make the adjustments over here. Debit goodwill, because it's part of non-current asset. Goodwill figure went up. Then how about NCI? NCI figure came down. Debit NCI. So NCI figure came down. What will be the third entry? Deferred tax liability is a liability figure. That means this liability is supposed to be shown on the SOFP liability side. So we'll just write over here credit liability. So what is the amount? 6 million. How much will go for NCI? The NCI percentage of it. So 40 percentage of 6 million will come up here. So the balance is 6 million minus 2.4 million. So 6 minus 2.4 is equal to 3.6 million. These are the adjustments that have come up within the calculation for deferred tax, and we will make these adjustments as well on our SOFP. So what all three things we took from the paragraph? Fair value changes to be made, 15 years life is to be done, tax rate is to be done. So these are all the changes that happen. Now this is on the date of acquisition. What would happen to this deferred tax liability subsequently? By the end of the year also some changes are supposed to happen. What changes could happen over here? This deferred tax liability might increase or decrease based on the changes by the end of the year. In the case study, no extra information about assets are given. So we can just assume what changes are going to happen over here. We can say that by the end of the year, the difference will be by date of reporting, carrying value will be 28 million. That is 30 million was the gap, 2 million was the depreciation. So by the end of the year, 30 minus 2 is equal to 28 million. How about the tax base? Tax base, no adjustment will be there because we made a difference, only the adjustment for the difference part we made. So again, carrying value is greater than tax base by 28 million. So what will be the closing deferred tax liability? It will be equal to 28 million multiplied by 20 percentage. So that is 5.6 million. Now, should we make an entry for 5.6 million completely? No, because opening was 6 million, closing is 5.6 million. So the overall liability figure came down. We have to make an adjustment only for the change that happens in the deferred tax liability over the year. So how much liability decreased over here? 0.4 million decrease happened. So we'll just write over here debit deferred tax, or we'll just write debit the liability part by 0.4 million. So that is the difference between 6 million and 5.6 million. How about the credit entry? Deferred tax is an implication that came up due to fair value adjustment. Whose fair value adjustment? Subsidiary's fair value adjustment. So if something related to subsidiary happens and that part of income goes to SOPL, because debit liability going down is a good thing. We're supposed to record an income in SOPL. This income will affect the profit after tax. This will come and hit on equity, where all parents percentage of that gain will go to GRE, NCI percentage of gain will go to NCI. So we'll write credit group retained earnings by parent percentage, credit NCI by NCI percentage. So that will be equal to 0.4 million multiplied by 60 percentage for parent, 0.4 million multiplied by 40 percentage for NCI. So we got the adjustments to do post acquisition, what happens with deferred tax, and that also will mark in a different color and keep it over there. So now we got all the adjustments that were supposed to be done for the net asset part and the adjustments over here. These numbers are also going into the SOFP. But before going on to the adjustments for SOFP, we can make the explanation over here, because in the word processor, explanations are supposed to be there. So we can start off writing. While consolidating, as per the rules, all assets and liabilities are to be carried at fair value. Currently, the figures are recorded at their carrying amount. Hence, fair value adjustments are required in fair value adjustments are required. Okay. Number one, what adjustment we made first? The additional asset value. A factory building of carrying value 10 million is to be increased to 40 million fair value. Hence a gain of 30 million at 30 million at acquisition date happens. What entry we have to pass for this? Debit NCA, credit goodwill, this thing. Let's see if the copy paste function works over here. Okay, copy paste functions works on this. So hence a gain of 30 million acquisition will happen. So debit NCA, credit goodwill by this amount, credit NCA by this amount. So that is sorted. After this, what will happen? What was the second thing we did? We have to do additional depreciation calculation. As the remaining life was 15 years, there will be an excess depreciation on this asset calculated as 30 million divided by 15 years, which is equal to 2 million. What will be the entries we have to pass? Debit GRE, this one. So we can take the numbers, we can copy paste it over here. So this one, debit NCI and credit non-current asset. So that is also sorted. What was the next adjustment to do? Deferred tax implication. As the fair value of assets increased in consolidated statements, this creates a difference between the consolidated books and the tax base in individual financial statement as tax payment is based on the individual individual financial statement numbers. The difference of 30 million between the two creates a taxable temporary difference. Why? Because carrying value is greater than tax base. Normal IAS 12 rule, that is. And this multiplied by the 20% tax rate gives rise to a deferred tax liability at date of acquisition of how much amount? Deferred tax was 6 million. So of 6 million. What entries we have to pass for this? We'll just copy paste from here. Copy paste. So debit goodwill, debit NCI, credit liability. So that is sorted. What is the next adjustment we did? By date of reporting, there will be a change. By the date of reporting, the difference in carrying value and tax base would turn out to be 28 million, which is 30 million minus 2 million additional depreciation. This multiplied by tax rate of 20% gives a, how much was the closing? 5.6, right? No, yeah, 5.6. So gives a deferred tax liability of 5.6 million at date of reporting. As the deferred tax liability has decreased over the year by 0.4 million, this change will have to be accounted for by passing the following entries. What are the entries we have to pass? Debit liability, this one, this one, this one. Now we got the entries as well. Credit GRE, credit NCI. So we have all the entries. We have made all the explanation as well, what all numbers we have done. And just for reference, you can just write at the top itself. Either at the top or at last, you can say. Refer to spreadsheet for detailed calculations, so that the examiner doesn't think that we bluffed the answers or we just copied from somewhere. There is a proper structure to what we have written over here, so this is easily referable. The exam itself is giving you two response option. That means make well use of these two, and you can structure it accordingly and make your life little more easier when presenting the answers. Now you might think that, okay, we did lot of detailed calculations on the word processor and the spreadsheet as well. Did we lose a lot of time over here? No. This is where our boost is coming up. Why these numbers and red color fonts are going to help is because in your question number 3, it was said that using your exhibit 1 and 2 and your previous answers, make adjustments to consolidated SOFP. So what we are going to hit right now is, with this time that we spent on a proper structure and a plan, we're going to hit on our question number 3 directly and make all the adjustments that are needed. Which means all these figures what we adjusted, we made the entry over here. We're going to go back to the consolidated SOFP, the pre-populated one which is given. We're going to just keep on connecting each cell over here and clear off those adjustments. Which means we spent enough time structuring our part A of the question in order to easily get over the part 3 of the answer as well and grab the marks collectively over there. So let's start doing that part. First entry is goodwill and liability. How much amount? 31. So goodwill and liability. Where is goodwill? Okay, goodwill is over here. We have to connect it over here. Goodwill will be 31.7. Credit liability, that is equal to The title is not given over here, so I think we can make an adjustment. Non-current liability, the title is deferred consideration. Oh, it will, okay, initially it will be under deferred non-current liability, but by the date of reporting, then only one more year is pending. Then we'll have to shift it from non-current to current liability. So first itself we can write over here. Either we can make the adjustment to the side, or I'll just write the heading over here, deferred consideration, since I have the space, and I'll just write the number over here, but don't write it in the original number, make it in the next column so that the examiner can easily figure it out. So equal to 31.74 million. So first entry is done, 31.74 debit entry, credit entry. Second one is for the finance cost, that will go to GRE and to the deferred consideration part. So GRE will be decreased. It's a debit figure under equity, so we're going to decrease it, equals to negative, or we can just make it in the second column, equal to negative 1.58 million. And if we go to the deferred consideration part, it is a credit entry over there, so this is going to increase over there. So second entry is done. If we go to the third one, net asset adjustment, so we have three entries to make on non-current asset, goodwill, and NCI. Goodwill is going to go down, non-current asset is going up, NCI is going up. So let's go one by one. We'll take the third column, non-current asset, property, plant, and equipment is there. This is going to increase by 30 million. Goodwill is going to decrease by 18 million. NCI is going to, where is NCI? NCI is going to increase by 12 million. So that entry is done. Fourth entry is, either you can scroll down, or just to quickly see, you can see the numbers from your word processor as well. Anything is fine. So additional depreciation is to be done. GRE, NCI, non-current asset. So let's go one by one. Non-current asset. Additional depreciation means your asset value is going to go down. So non-current asset is going down by 2 million. GRE, retained earnings, is over here. It is going down by 1.2 million. And non-controlling interest, this is going down by 0.8 million. So that entry is done. What is the next set of entries coming up? Deferred tax liability, that's for goodwill, NCI liability. So goodwill is going up, NCI going down, liability going up. So let's go to goodwill. Where is goodwill? Goodwill is over here. We'll go to next column. Goodwill is going up, I believe. So deferred tax implication, goodwill will go up by 3.6 million. NCI was a debit, so we'll go to NCI column, debit. It's a negative figure, so we go to NCI. NCI is 2.4 million decrease. And deferred tax liability, we can go to the deferred tax line. It is credit entry, so we're going to increase it by 6 million. So that is done. The last entry was related to, after deferred tax liability, we have the adjustments for post movement after the after deferred tax liability coming up, that 0.4 million adjustment. So deferred tax is going down, GRE is going up, NCI is going up. Okay, so let's go to GRE. Where is retained earnings? Retained earnings is over here. So we'll take the next column over here, retained earnings. Okay. Retained earnings is going up by 0.24 million. NCI is going up by 0.16 million. And finally the deferred tax liability, this is going down by 0.4 million. Where is it? 0.4 million. It's a debit figure, so we're going to put a negative sign over there. So we made all entries as of now from the part A of the question, and we have got the answers. Just to quickly cross check if we made the correct calculation so far, what we can do is we can just sum up everything to the right and see whether our numbers are matching out or not. So what we can do is, we have the asset column over here. We'll just leave some space because part 2 of the question is coming up. So we'll just leave some space over here and just type equals to sum of everything that's going to come up over here. Done. Now that was an asset column, so there's nothing, but forget that. We're just going to add up everything till the total asset column. Whatever zeros are coming up, forget all that, doesn't matter. We have the total asset, which is going to be equal to the sum of everything on top of this. That is our total assets. And the same we're going to do for the equity and liability part. So equity starts from here, share capital, and we're going to copy this entire thing till the total equity line. The total equity will be equal to the sum of all this on top. That is the total equity line. And we have the non-current liabilities line. So we're going to copy this formula down for the non-current liability. It starts with deferred tax. So here nothing is there. We'll just, for namesake, I'll just copy there. Deferred tax, current liability, deferred consideration, till here it will come up. And total equity plus liability will be the sum of all the numbers on top of this plus the total equity part. Did I do some mistake? I added all these numbers. So we have a difference. Let's see why that difference has come up. Here the formula is total non-current liability. So non-current liability, total liability. Okay, that is fine. And equity, share capital, other components of equity, NCI, that is okay. Total equity, okay. So this side is fine. Here we have two assets. Okay, that anyways was zero. Forget that. Okay, we'll just remove. Non-current asset, okay, nothing is there, we'll remove. Then property, plant and equipment, intangible asset, goodwill is there. This is a free line 0. And okay, we have a total over here that was okay. We'll just remove the total figure. So that was not supposed to be added, because anyways we're adding the whole thing together. So if that total non-current asset figure is over here, we are just double adding it, so that's why that mistake is there. So we remove that. Oh, I think it's matched already. 1120.346, 1120.346. All right. So we are done with our first part and the third part's first part. Okay. So all that adjustments related to exhibit 1 is totally done. And this is how we are solving our answer. Now let's go to part 2 of this question. Part 2 of the question is related to something, some other companies and some sales company, and that's a 5 mark question. So we're expecting to finish this quite quickly. That is a share sale. So let's see what this is. Share sale is several years ago. Enric's company purchased 75% of the equity shares of Sal's company on 31st December X7. So that is the year ending. Enric's company sold 10% of the equity shares of Sal's company. So from 75, you're coming down to 65%. It's a control to control movement, a step disposal. Now, this reduced its holding to 65%, but meant that control over Sal's company was still retained. Okay. Cash proceeds of 22 million were received from the sale of 10%. Okay, with the other side of the accounting entry being recognized as other income in the consolidated SOPL, which means debit cash they recorded and credit 22 million gain they have recorded in the SOPL. That's what they're telling. The other part of the entry, cash received from sale, and other part of the entry went to SOPL as an income. Now, no other accounting entries have been recognized in respect of a share sale. Okay, so based on the first paragraph, main information we have is, where is our word processor? We'll just write over here. This is related to now requirement 2. Requirement 2, that is related to share sale. In that working note 1, we can just write about, okay, I think only one paragraph was there. We'll just write the general information and just keep it over here. Here's a paragraph. Okay, get this. Okay, so we have okay, one entry made right now is some information is given about an entry: debit cash 22 million, credit other income in SOPL, that is recorded as 22 million. This is the correct current entries they have made. Okay, current entries, but it is the wrong one, so we can just write over here wrong entries made. So that is the figure we have. Then it is given that movement is 65 10% movement, so it's a movement from 75 to 65 percentage. So basically we are giving our territory to our enemy, that is the NCI people. So just keep that in mind. Concept is we are giving up our territory. So when parent is giving up their territory, we have to see the portion of net asset, we have to see the portion of goodwill, multiply it with the NCI percentage, then see how much worth of territory am I giving up, and compare it with 22 million and see whether I have a gain or loss. Which means the correct entries in a step disposal when it's a control to control situation should have been debit cash. I got 22 million. There, no problem is there. But what will be the other part? NCI is now increasing. Previously, NCI was only 25 percentage. Now NCI is becoming 35 percentage. So NCI value is increasing by some part. So we have to calculate that NCI percentage, how much increase is happening. So we have to calculate it as 10 percentage, that is the gain, multiplied by the goodwill and net asset at date of reporting. Meaning by that time, what is the net asset figure, what is the goodwill figure, that you have to multiply with 10% and give it to NCI. Then finally you might have, this is credit entry, and you might have a debit or credit based on the gain or loss you made on the sale. And where will this gain or loss go to? It will not go to SOPL, it will not go to OCI, rather it will go to OCE within the equity part. So remember, control to control movement is an adjustment to be done within the equity, and it is not going to your SOPL or OCI. Now we need to find out these numbers, but let's read the remaining paragraph. Net asset of sales company in its individual financial statement on 31st December, that is the year ending, was carried at 146 million. So net asset of subsidiary company was 146 million. Okay, fine. On 31st December X7, that is the year ending, okay, this is individual financial statement. So this is the carrying amount. All right. Sales company owned land which had a carrying amount in the individual financial statement at 6 million. That means within this 146 million, there is a land that has a carrying value of 6 million at the acquisition date, but a fair value of 18 million. Now, 146 million is given at what date? 31st December. Now, what is given over here? The land value is given on acquisition date. So, acquisition date land, if I want to bring it down to the last figure, do I have to do any depreciation or any adjustments to be done? No, because land has no depreciation. So that is a catch over here. Don't get confused about the point whether, okay, land is given at acquisition date, remaining net assets is at the reporting date. How do I move from here till here? So keep in mind, land, no depreciation. Whatever value you have here, it will be same over here. Now, it is already included at 6 million, but the fair value is 18 million. So how much increase I have to make to get the fair value of net asset? I have to increase it by 18 minus 6, that will be 12 million. So from 146 million, I have to increase the net assets to, we have to increase it by 12 million. So it will be 146, 156, 158 million. So it will increase to 158 million. We'll just write over here, net assets will increase by 12 million. So that is equal to 146 million plus 12 million, that's equal to 158 million. So that is also fine. Then they have told it is group policy to measure the non-controlling interest at its proportionate share of fair value of subsidiaries net asset. What is the fair value of net asset? 158 million. How much NCI is there in the company? That is not our concern. What is our concern over here? We just want to find out how much increase is happening. So how much increase is happening? 10%. So equal to 10 percentage multiplied by 158 million, that is equal to 15.8 million. So one part is okay, but we also have to find the goodwill and multiply it with 10%. Only then we'll get the total increase or decrease. But this is where the catch comes in. This is calculated as proportionate method. Now go back to our FR knowledge. In goodwill calculation, we have two methods. One is full goodwill method, where the goodwill we calculate is for parent and NCI. But we have the other one which is called as the proportionate goodwill method, where the goodwill is only for parent and not for NCI. Which means whatever number of control we are giving up or taking up, that amount of goodwill is only for parent and it doesn't go to NCI, which means in this particular format, because it is a partial goodwill method or a proportionate goodwill method, we don't have to consider the goodwill within the calculation. We just have to calculate the net asset. For reference, if you want, you can just write over here, not necessary, but just writing goodwill not considered because proportionate method for NCI. So that's enough. And how much is the value? Total NCI increase is happening by 15.8 million. So I'll just copy from here, 15.8 million. So now what is happening? NCI is increasing by 15.8 million. That means I gave up territory worth 15.8 million and I got cash of 22 million. So I gave this much territory, but I got this much money. So I made a gain over here. How much gain is there? 22 minus 15.8, that's equal to 6.2 million gain. Where is it going to? OC, equity part. These are the entries we have to make for this particular thing. Now keep in mind, debit cash was already made. Debit cash is already there in the correct entry as well. That means I have to make some adjustments. That is, this wrong entry, now I have to reverse it. And the correct entry, I have to make it correctly. Since debit cash and debit cash is there in both, I don't have to bother about that. Only the remaining ones I have to make an adjustment for. So the correction entry that I have to do over here would be, first thing, that credit income what they have recorded, I need to reverse it. So it will be debit other income from SOPL. Now are we making SOPL over here? No, but that SOPL will come to the SOFP part within equity. Where will it go and hit? Just think of this. Who is the seller over here? Parent is the one giving up the territory. So parent is the one selling it. Parent is the one getting the money. So parent is the one who made this profit. Now, if parent's profit is there in SOPL, it will hit the profit after tax. And when it comes to equity part, where will it go and hit? Parents figures go and hit on the group retained earnings, GRE part. So this SOPL figure, we are going to adjust it within the GRE. We are going to decrease it over there. How about the remaining entry? The correct entry is credit NCI, this one and this one, all this is same. So we're going to just copy paste it. The numbers didn't turn out to be correct. So I'll just write from here 15.8 and this is 6.2. So those numbers came up and these are the entries we have to pass over here. This will be the entries related to part B of the question. So one thing we can do is we'll just quickly wind up the section, part C of the question, that is making these adjustments on the consolidated SOFP. What we'll do, we'll go to GRE and reduce 22 million. Where is GRE? Retained earnings is there. We'll just reduce this by 22 million. 22 million. NCI is there, credit. So that's going to increase credit NCI by 15.8 million. And where is other components of equity? Other components of equity is over here. So that is going to equal to increase by 6.2 million. So that was a gain. So we'll just remove all these entries. It was credit gain we made, credit gain. So if we go back to the adjustments, let's see if everything is matching out. We made the adjustments and you can see since we copied the entire sum over here, the numbers are anyways considering those adjustments for other components of equity. You can see that group retained earnings is also considered and you can see that non-controlling interest is also considered. This gives still the balance of 1120.346 on both total asset and the total equity plus liability, which means our part 3 of the question is sorted. Now we just have to make adjustment for this last part within our word processor as well. So we'll just close this one. We'll take our word processor and we'll fill in the answers. What is supposed to be written over here? Starting off with the entries related, we'll just give us some basic case study what happened over here. It's a control to control movement. So what is the main company's name? Hendrix company. Okay. Hendrix company initially had 75% shares in Sal's company and made a disposal of 10 percentage in it. Now, this is a step disposal where control to control movement happens. In this situation, there is in this situation, as per consolidation rules, it is treated as a adjustment within equity, that is transaction between the shareholders. Hence, the entries to pass over here are, we're not writing the numbers over here, we're just writing the accounting standard part. The entries are supposed to be debit cash received, credit NCI, credit or debit the gain or loss. We'll just write over here, this goes to OCE. Credit NCI, how is this calculated? As increase in NCI percentage multiplied by goodwill plus net assets of subsidiary at date of reporting. Goodwill also, right? Goodwill at date of reporting. Then debit cash, this is the sale proceeds received. So we wrote how to get the numbers, what are the calculation involved, the accounting standard part is there. Now we connected to case study. What is done over here? They've made a wrong accounting entry. Currently, the company has made a wrong accounting entry on the credit side by recording a total income in SOPL. So the entry passed is, we'll just copy paste from here, debit cash, credit, other income. So this is the entry they have passed. Okay, and this is included within the retained earnings figure. What did we do? We made the correct entries. How? We calculated this way. As per the correct entries mentioned above, the entries are supposed to be like this. Now, if we simply write the numbers, it looks a little odd. So we'll just quickly write 22. We know how it is. 6.2. We know it's a difference. So all that we need is how did we get the 15.8 million? So we can just write over here, which is calculated as 10 percentage multiplied by 10 percentage multiplied by, where is it, 158 million. 10 percentage multiplied by 158 million. Now we have to say what is this 158 million. So we can just write before this or after this. So as per the correct entry before this, we can just write over here, the carrying value of net assets are at 146 million. Within this, a fair value adjustment on land is to be done by increasing it by 12 million, which is 18 million minus 6 million, and this gives a fair value of net asset for sales company at date of reporting worth 146 plus 12, 158 million. Hence, as per correct entries mentioned above, the entries are supposed to be like this and 10% over here. You can just write over here that sentence which we mentioned as well. Where is the spreadsheet? Goodwill Goodwill is not considered for above calculation because proportionate method for NCI is used. Hence, the correction entry to pass over here would be correction entry will be these numbers. So that will be equal to debit this one, credit NCI, credit gain 6.2 million. So with this, we're done with the explanation part of how we got those numbers, and the same sentence we're going to write over here as well. Refer to the spreadsheet for detailed calculation. So we explained the situation, we told how the accounting entries are to be happening, what is the IFRS standard, what does the standard say about the accounting part, how the entries are supposed to be, how we got the numbers, and explanation of further numbers and things and all. It is there on the spreadsheet. We made the adjustment on the part C as well. That means part C got simultaneously completed along with doing the section A and B. So with this, the complete 30 mark question, that is for your question number 1 related to consolidation, is completed. Hope you have followed with the structure and the approach of how we did this particular question and the amount of answers that is required within your solution as well. Hope this was helpful. See you in the next video. Bye bye.